We have fresh off the press, what you've missed in Australia's startup landscape. Now I'm going to introduce our wonderful moderator, Bronwen Clune, VC and startup correspondent at Capital Brief, to come up and introduce the panel. So if we give them a round of applause.
Afternoon. Is this on? Can you guys, there we go. I'll sound quite deep through this. Afternoon, everyone. Welcome to us after lunch. Our panel is fresh off the press, what you've missed. The way we've decided to do this panel is actually conduct it like a live interview, so we haven't done much prep. I'm going to ask the questions of the panel, and we're just going to talk through things and keep it very casual. We will take questions from the audience, so please feel free to just let me know that you do have a question while we're going, and we will get to you at the end. I'm going to ask my panellists to introduce themselves because they all know how to pitch themselves and their business, and they probably do a better job than me.
Hi everyone, my name's Kirsten Hunter. I am the CEO at Birchal, which is Australia's largest equity crowdsource funding platform. Prior to this role, I am a FinTech founder myself, so I was one of the co-founders at Future Super, and then I've also been an investor as managing director at Techstars up in Sydney.
I'm Alex Simmons, co-founder of Cashcade. We're Australia's fastest R&D lender, so we help companies access their R&D refund ahead of time. My background is in banking and consulting, worked with a lot of financial institutions across the APAC region over the last 10 years.
Hey everyone, Ben Buckingham. I'm from Primary. We're a cash management, treasury management platform for high growth companies. And one of the use cases that we focus on is helping startups and scale-ups that have done really big fundraising rounds manage their cash. So we get quite a lot of insight into what's happening in fundraising rounds, and then afterwards what metrics are looking like for businesses as they start spending that cash.
One of the things I think that kind of is similar amongst all these different companies up here is you're all startups helping startups and founders kind of get funding. So you've got really interesting perspective from the startup perspective, but also good insight across the industry. One of the things when we were all here last year is everyone talked about the funding winter. And how hard it was to raise money. Be good to hear all of your reflections on where we're at the moment, like how hard is it out there and what are you seeing come through your own sort of companies? I don't know if you want to kick that off, Kristen, with where we are with crowdfunding.
Yeah, happy to. I mean, I'll speak a little bit broadly to start with, but I think when it comes to funding, it has kind of always been hard, and it still is hard. There was a brief reprieve there in 2022 when money was cheap and it felt like it was really easy to get access to it. But since that time, there's been this real volatility when it comes to funding, and that's been seen in VC as well as in crowdfunding. 2022 was a big peak, and we've never kind of returned to growth in the funding landscape since that time. So there's been kind of moments where it's looking more promising, and then the next quarter we'll see it sort of drop back down. So I think that's the first thing, is that this real kind of volatility, like persistent volatility over the last 3 years, particularly I think if you are a woman founder from, with diverse background, 85% of the VC funding, even in this volatile market, goes to all male founding teams. So it's tough for everyone. It's even more tough if you're not an all male team. The second thing is I think even that volatility is a little bit distorted at the moment because so much of the money that is going out is going to AI-based companies. And so if you're not an AI company, even if you're a company with a really great idea that's utilising AI in interesting ways, but you're not an AI company, it's even tougher again. But the good news I think that I'm seeing is that necessity is the kind of mother of invention, and when founders can't get access to capital through the traditional pathways, they find their own pathways. And so that creates this real opportunity for a thriving ecosystem where we're seeing a lot more founders bootstrap and sharing lessons about bootstrapping or seeking alternative sources of funding. There's some really interesting debt solutions that have come. Obviously, Cashcade is one of them. Crowdsource funding has a really important role to fill the gap in there as well. So I think it's kind of forcing founders in Australia to be a little bit more creative about where they're getting the money from that they need to build their businesses. And again, like another positive trend is that AI makes it a lot easier to build without having heavy engineering costs.
Yeah, Kirsten, I can probably build on that as well. Like, I think not only are founders becoming more aware and implementing smarter strategies to diversify their capital stack and to reduce their cost base until it's the appropriate time to then step that up. But we're also seeing like a greater maturity of the capital environment as well. When you look to like UK and US markets, there are so many different types of capitals available to companies, to people building these companies that are trying to do something new and step into a new territory. I think we're starting to see that a little bit more here, and particularly one area that we've seen through the 300 companies that have come through our door over the last 12 months is high net wealth investors participating with checks between 25 and 50,000, or they're operating in a syndicate and they're starting to contribute a meaningful amount of money. We're starting to see that build up as a key part of the capital stack as well. And then also just the diversity of different types of debt products, different types of other equity investments, different ways to weather a storm like we've just had with the valuation compression. For example, you can invest money through a convertible note or a safe note that converts later depending on what the valuation is at a later point in time. So there are these other ways to kind of work around that kind of thing. And I think outside of the market maturing in that way, we've also seen a bit of a distinction between where the capital flows. From the data we have, we see quite a lot of money now starting to return to quite early stage ventures and later stage ventures, but there seems to be this gap in the middle for kind of around the Series A type business as well. I think they're struggling a little bit more.
That's definitely what we're seeing in our portfolio of companies, where we're getting lots of traction with new companies that are raising smaller rounds at the pre-seed, seed stage, and then the later stage companies that we already work with coming in and doing, Series B, Series C, Series D, and raising 50, 100, 150, $200 million. And so it feels like there is a big gap in that, Series A, pre-Series A to B stage in the market. And I think one of the things that's creating is a need for alternative funding mechanisms to get through that hurdle. We've often talked about different types of commercialization valleys that are challenging. This seems to be the one that is challenging now in Australia, getting from seed through to Series A and then to Series B. And so I think from a cash management, treasury management perspective, looking at R&D funding is obviously something that a lot of our clients are doing, but then actually borrowing against it to help bridge that gap, super important. And then also, I think the other thing that we're seeing, because there's less of these Series A rounds, is more of these sort of pre-A rounds that seem to be happening as well, which are either seed extensions at the same valuation or, oftentimes quite a significant valuation uplift, but not quite at that Series A level. So that's what we're seeing.
Yeah, it's kind of hard to keep up with what a round is these days. There's pre-seed, seed. We've invented a whole new kind of language around that, which it's always been the same thing. I think one of the things that has become clear to me in reporting on this round is how attitudes have shifted around what we call about alternative funding, where, basically getting VC funding was the ultimate validation for a startup, and I'm sure you've all experienced that yourself. Where now, these other alternative forms of funding are legitimised and are kind of being accepted in the ecosystem as something as still a mark of, you've got something here. Be interesting to hear from you about what you're seeing in terms of, the shift in attitude to these alternative assets, and if you're seeing the acceptance as well from VCs in these alternative fundings. I don't know if you want to start on that.
Yeah, I can definitely start. I think what we have seen, and so just for a bit of context, like we often help people bridge through to the imminent round. It might be in 3 or 6 or within 12 months, say. And so we often go in there, we understand what their need is, how long they need, and what they want to achieve by the time they then go out and start the next round. And it's typically milestone based or whatever it might be. And so we've seen people say, okay, maybe a few years ago it was, we want to go to these VCs, we think they're a good fit, and we want to raise $2 million from them, maybe one from that one from that one. Whereas now it's a much more diverse approach, and they're looking to do certain things at certain points in time. It's not as distinct as every 18 to 24 months we will do a big whack of funding. It will be, okay, we might do this here, we might do a little bit of bridge there, we might do that. And it almost feels, maybe this is an optimistic view, but it feels like it's a little bit more bottom up. They're trying to solve for the purpose that they're, for the problem they're actually experiencing. And instead of just trying to fit themselves to this kind of Silicon Valley, sexy type of, pre-seed, seed, Series A, X, Y, Z. So it feels that like that's the kind of way that's starting to happen. And then from a VC's perspective, we actually hear them having conversations with these founders and these teams to actually get them to think a little bit outside the box and think about what does your business actually need as opposed to what is the traditional pathway. So it feels like there is some encouragement, and that's both on the equity and the debt side. It's, don't necessarily just take money from this VC. It's, well, have you really thought about why that would actually add value, and is that the optimal value that you can achieve?
Anyone else sensing a shift?
On the R&D funding side, I think that's become a very well-trodden path in Australia now, and no longer. If it ever was something that VCs were concerned about, certainly I don't think that's the case anymore. I think there's a philosophy that it's your money, you will be getting it at some point anyway, and so drawing down on it sooner, not an issue. There is still some skepticism in VCs with venture debt for sure. I think that there were clearly a few deals that went bad 10 years ago that have left a sour taste in VCs' mouths, and so that's hard to get rid of. But I do feel like it's certainly something that is starting to change. I can't remember what the exact number is, but I think we're at like 20% of venture debt levels in Australia compared to the US relative to equity capital raising, so still very small nascent market here, and more to go for sure.
Yeah, and it feels like a bit of just like figuring it out. And again, coming to like, why would you access that type of money? And so within like the venture debt world, you've got kind of more mature venture debt, like the traditional type models that are, maybe like over a 5-year period, and you've got a interest-only period followed by a term of, whatever it is, 60 months, that kind of thing where you pay down the principal. So there's that type, then there's the shorter term type models. It might be a revenue-based finance, or it might be a shorter term loan of 24 months or something like that. That also serves a different purpose. And then there's also like the R&D style funding, which is typically a lot shorter term. And for a lot of these people, they place a lot of weight on, okay, what am I relying on to actually pay that debt down? And so typically in the traditional world of business lending, corporate lending, you rely on the company's free cash flows, the profit that they make every month, to actually service and pay down the loan every month. In the world that we operate in, that doesn't exist. Okay, so how are you going to pay off that debt? Well, in the traditional venture debt world, it's either a path to profitability combined with maybe a probability of raising some equity capital. Probably in that kind of revenue-based finance world as well, it's still, okay, we're actually underwriting the next equity raise within the next 12 months, so let's just hope that you can raise that capital then. And then the R&D side, it's, well, you've got high conviction that this refund of $100,000 is coming in towards the end of the year, and that'll pay off the $80,000 loan. And so, yeah, again, it's just a matter of like everything's starting to mature and people starting to understand, okay, how can we fit this tool to this problem, and vice versa, actually.
Yeah. On the flip side, I'd say the perception is definitely still there, right? And in a lot of cases, the perception is actually fueled by people in venture as a self-serving tool, because the more venture is seen as the sexiest, the premium source of funding, the more they're going to have their pick of the best deals. And so, like, I think what I sort of always say to founders is not every deal is a venture investable deal, and venture is not the best source of investment for every company either. And so I've worked in a number of different companies that have deployed these exact strategies of a combination of equity and debt. It feels really attractive to raise money through equity early on. It becomes very expensive though when you're successful, whereas debt sort of kind of has the opposite kind of effect in a lot of ways. So yeah, like in some ways I think venture in Australia is a really interesting little sub-market, because we are a small nation. We have a decent number of dollars sitting in venture capital, but in a lot of ways we're not very creative in how we want to deploy it. We're looking for the next Atlassian or the next Canva, but we're not looking at the next Atlassian or Canva when they were at a pre-seed stage. We're trying to kind of pick them, make them fit that kind of match without being creative around what it looks like earlier on. And so again, like I think part of this is self-serving, but also part of it has to do with founders feeling like they don't have a lot of other alternative pathways. So the more these different sources of capital become available, I think the more we'll start to see that change. Crowdsource funding in particular, I mean, you know, I run Australia's largest crowdsource funding platform. I know crowdsource funding has a bad reputation amongst venture investors, amongst a lot of founders. It's seen as difficult, it's seen as the last choice of capital. But I don't think that's right. I think crowdsource funding can be a really strategic source of capital for the right businesses, where activating your customer base on your cap table can fuel these growth cycles, which can take you to astronomical levels that a VC investment couldn't have delivered for you. But my job is to find the case studies and the examples that show that proof point, and to be, you know, really focused in finding companies that I think are going to be strategically served by the choice of capital that I offer, and helping them be successful.
Yeah, it's interesting also from the perspective of a newsroom, is we often have relied on, you know, VC funding as the signal to the market of, oh, this is a company to write about, and how much did they raise. And we've got, you know, these different kind of pictures coming in now around they raised this much venture debt, or they got money from this way. And it's sort of shining light on the fact that, you know, these things are becoming more normalised, but how, you know, we'll hear about the founder who's sold their business for 400 million that no one's ever heard of, and it turns out they were bootstrapped. But those are stories that we kind of miss around this focus on VC. Where do you see this kind of going in the next year? I think we're starting to see some momentum on this, and we'll take questions from the audience after this. You know, what are your predictions of where this is going to get to in the next year? We're going to see more of this. Are there things we haven't thought about that we're going to see coming onto the market?
Yeah, I hope so. I mean, I kind of feel like we're at this crash or crash through point when it comes to VC funding. I think founders have been trying to fit themselves into a VC fundable mould for years. And, you know, the founders who I speak to are feeling pretty burnt out by trying to run that race. And as long as you're trying to raise capital from a source of funding that's not suited to you, that's time and energy away from building an amazing business. And so I think that sort of, you know, almost the kind of ineffectiveness of that market, not ineffectiveness, but like the fact that it's not the right source of funding for so many businesses is kind of going to force people to find these other pathways. In terms of what's possible, I mean, just as an example, Revolut, which is a neobank in the UK, they actually did their first round of capital raising through crowdsource funding in the UK. 460 investors invested an average of £2,000 in that business. That investment today is now worth £1.25 million. So 460 odd new millionaires off the back of a crowdsource funding campaign. So I think that's what's possible when we use these alternative sources of funding well, is a thriving ecosystem with incredible businesses that are successful because they could get access to the right source of capital at the right time.
Yeah, I completely agree. And I think there's like the supply side, which is the investor side, and there's the demand side, which is the founder operator side. On the supply side, we definitely see more people, everyday people who, you know, have gotten to that point in their career where they've saved enough money and they want to start to diversify their portfolio. Maybe they manage their own super fund in Australia, and they want to actually start taking bets because, you know, if you've worked in the telco industry your whole life, you've probably got some good information and insight as to like what a good opportunity looks like. And people are getting more comfortable and becoming more accepting of taking on risks within their portfolio. So again, the high net wealth investment base, spurred by a lot of the you know, tax incentives, like the early stage innovation company incentives, stuff like that, actually make it quite attractive, and we're certainly seeing a lot of participation.
Is that including family offices as well? Is that part of the mix coming in?
Yeah, family offices too. And I think we actually see quite a lot of family office activity. I think the family office approach, and I did used to work at a family office as well, is they do invest through a handful of funds. It might be through private equity, you know, a few private equity funds, a few VC funds, and they also like to do some direct things because, again, family offices are typically built off specialisation in a certain area, and so they do have network and expertise, which is the perfect, you know, place setting for an investor to be. And then I think on the other side, the demand side, where founders are thinking about it, it's finally we're talking about like normalize something that is actually like statistically normal. Like that's where most of the investment comes into these companies. It is through high net wealth family offices, not VCs. You know, what percentage of companies does a VC actually invest in? Probably less than 1%. And I think, yes, the jury is still out as to whether that model works here in Australia. But I think at the moment, like we've seen some recent, like we were talking about before, some recent narrative from some of the primary VCs saying that yes, their fund is returning the IRR that they actually need to hit for it to make sense. And so that's great. But again, that's going to work for certain types of companies, but certainly not the vast majority.
Capital Brief quoted Rick Baker this morning, growth is back, baby. So I think
we added the baby.
Actually, maybe the
he
baby
didn't say baby.
What was the quote? Growth is back. Growth is back. So I think, look, we'll see a lot more venture capital activity this year for sure. I think it's relatively well known that there's an inverse correlation between venture capital investing and interest rates. So as interest rates come down, tend to have more venture capital investing because the return hurdle is lower. And so we've got a couple of rate cuts forecast for the end of this year, both in Australia and the Fed in the US. And so start to see interest rates coming down, which I think will keep pushing that activity. And then over the past, particularly in 22, going into 23, going into 24, a lot of discussion around all the dry powder that was in VC funds. That's still there, I think. So there's been some very big late stage deals happening, and some the smaller ones, but still a lot there. And so I think that'll get deployed this year.
I find that really interesting. I think something that really hit home for me was seeing the announcement of a recent $600 million fund from one of the private...
Airtree.
Was it Airtree? Okay, so Airtree's, yeah. And they've allocated $150 million to early stage companies. Okay, $150 million. If their average investment into early stage companies is in the order of $1 million, that's only roughly 150 companies or so. There's 4 million companies out there in Australia, thereabouts. And so again, if we think about the maybe, I don't know, like 15,000 startups there might be, again, that's a very, very small percentage. And they're going to deploy that over the next few years.
And they're one of the biggest.
Right? Yeah.
Do we have any questions? We don't have that much time, but if anyone's got a question, do raise your hands, else we'll keep going. Yeah.
Hi. Interested in if you have any variations for social purpose-driven businesses or environmental-driven businesses, and if there's any difference in how they should approach it.
Certainly two areas which haven't got a lot of funding love recently. Climate tech is surprisingly one who's also kind of suffering. Anyone got any thoughts?
Yeah, I mean, sustainability was the third largest industry on crowdsource funding last year. Historically has always been in the top 4. I have been a founder of a green FinTech business in Future Super and worked in a bunch of purpose-driven businesses as well. I think it's always tough because you have investors and then you have impact investors and then you have philanthropy, and you don't really fit neatly in any of the buckets. So I think my best advice to founders in that kind of impact purpose-driven space is you've got to be able to tell both stories to both audiences and weave them really well together. The best impact-driven businesses that can attract this external source of capital are ones where your impact is tied to the scale in the business. And so as you grow your company's kind of economic metrics, you also grow your impact. It's a little more difficult to attract impact investment if you're kind of like, we will grow and then we will donate a portion of the products, or it's less connected to the growth. But again, I think crowdsource funding is an amazing opportunity for these type of businesses because you have investors who want to back the idea. They're not necessarily looking for a straight up financial reward, although obviously that's part of the equation as well, but they might be willing to take the risk on a great idea and give you that opportunity to get the funding to prove it out, which down the line might make it more attractive to more traditional sources of capital.
There was another question over here somewhere, I think.
I was just going to ask, obviously AI is a hugely hot topic, and it already came up in, if you want investment, be an AI company, essentially. Are you also seeing that in the demand side, in companies either wanting to raise less or delaying raising because of efficiencies they're finding in AI? You talked a little bit about bootstrapping. It kind of feels like that's going further and further and further, and it's often the small companies that take advantage of these new tools first. So, yeah, just keen to hear what you're seeing there.
I think that some companies use AI as an excuse to fire lots of people within their companies, and it's an easier narrative to investors. I think that you obviously can go a lot further now with a smaller team, for sure. Bootstrap things more easily, for sure. Get to revenue faster, for sure. I think those things are all true.
And test out prototypes with low code, no code is something that, even 12 months ago, the standard of output that you could get from low code, no code was nowhere near what it is now. Like, a number of my companies in last Techstars portfolio were primarily using low code, no code. They were non-technical founders who were able to get a technical product to market on the basis of those tools. Now, it might not be infinitely scalable, but it gives you enough information early on to validate the commercial aspects that then you know what you have to build. So I think that's where I'm kind of seeing it at the pre-seed stage. More bigger picture, I think, I don't know, AI is probably likely to follow the same kind of trend that like digital had 15 years ago. Like 15 years ago, people were like, what's your digital strategy? And now there's no such thing as a digital strategy. It's just part of your strategy. I think AI is going to be the same. Now we're seeing AI as a vertical, but I think AI is going to become a part of everything.
Any other questions? Yeah. Oh, just wait for the mic because I think we're recording the session. So.
Kirsten, what's the ideal investor and the ideal startup for crowdsource funding?
I think the ideal investor is everybody, but that's the point of it. We allow a large number of small checks to bring a capital raise outcome to life. We actually have a lot of wholesale investors and professional angels who invest through crowdsource funding as well to get diversity in their portfolio. It makes it really scalable. From a company side, I think it's a bit more interesting because really what we want to see is companies with a really strong community pool. It doesn't necessarily have to be customers, but that kind of drive from the community and that real belief in the community to bring a business to life, I think, is what makes it successful. So that can be customers, it can be waitlist, it can be people who just really want to, even in a B2B sense, if you've got a bunch of staff who want this company to exist because they want their boss to buy it. I think that's kind of really what we see is companies with a strong community pool are best placed to raise through the crowd.
And that is all we've got time for, folks. We've finished perfectly on time. So please join me in thanking our amazing panel as well.